Welcome to Dealmaker Diaries, where we dissect the intricate stories of individuals who've mastered the art of deal-making, the intriguing stories of financial moguls and market mavens. Today's spotlight is on the maestro of the 1980s, the man who danced on the edge of Wall Street's high wire, Michael Milken, the junk bond king. Fasten your seatbelts, because this is a roller coaster tale of downfall and redemption. Picture this: the 1980s, a time of excess, neon lights, and a booming economy. Ronald Reagan was steering the ship with pro-capitalist policies, and Wall Street was the playground of the bold. Enter Michael Milken, the man who embodied the spirit of speculation and greed. But before we dive into the whirlwind of Wall Street, let's peek into the mysterious early years of Milken. Known for his reclusive nature, Milken's childhood was comfortable, thanks to his father, the accountant. Despite losing his hair in his teens, Milken adopted a philosophy: I don't know if I'm smarter, but I can work 25% harder. And boy, did he prove it. Milken, the hustler, studied business at Berkeley. A turning point came when he stumbled upon a financial gem by W. Braddock Hickman: the idea that lower-grade corporate bonds offered higher returns with equal risk. This was Milken's golden ticket to spotting overlooked opportunities in finance. Fast forward to Milken's rise at Drexel Firestone, an investment bank. Starting as a high-yield bond researcher, he pitched the idea of a high-yield bond department. Given limited capital, by 1976, he generated a whopping 100% return, making him Drexel's golden boy, the birth of the junk bond king. Milken's bond operation, based in Century City, California, kicked off in 1978. A small team, a demanding leader, Milken was in his element. With work hours that could rival a superhero's schedule, Milken's empire grew. The compensation was insane, up to 5 times more than Wall Street, attracting employees like bees to honey. But, as they say, with great power comes great consequences. The grueling work hours led to imbalances. Drugs, extramarital affairs, and health issues became the dark side of Milken's success story. Now, let's talk disruption. Milken targeted struggling fund managers, providing them with a lifeline in the form of high returns. His meticulous research on low-grade issuers countered investor reluctance, paving the way for the rise of the junk bond market. Milken argued that a diversified junk bond portfolio offered better returns and higher liquidity, convincing investors to take the plunge. Here's the twist: the junk bond market was the Wild West of finance. Unregulated, no listed prices, a playground for Drexel to earn substantial fees, sometimes as high as 30%. Milken's early clients included the who's who of wealthy Jewish financiers, enticed by his innovative ideas. But my friends, as the saying goes, what goes up must come down. Milken's empire faced scrutiny, investigations, and legal battles. Now, let's rewind to a time when Wall Street was a Wild West, and Milken, despite his troubled past and lack of a formal education, fearlessly took the stage. SEC scrutiny? Not a problem. Milken welcomed controversial partners like Ivan Boesky with open arms. Together, they were about to shake the financial world to its core. Now, let's talk about Milken's infamous partner in crime, Ivan Boesky. Picture this: 1981, the era of leveraged buyouts, and Boesky was on a mission. Milken, being the risk-taker he was, financed Boesky's venture with a cool $100 million at a jaw-dropping 17% interest rate. This marked the beginning of a duo that would go down in financial history. One of the great things about this nation is that we can seek profit, and I'm proud of that. Milken's unapologetic pursuit of profit was changing the game, but little did he know, it would also lead to controversy and legal battles. The 80s, a time of corporate takeovers dominated by big players. Milken faced a challenge attracting these giants, so what did he do? He shifted his focus to smaller firms with limited options. Hostile takeovers became his weapon of choice, a tactic shunned by big banks. Milken, however, saw it as a game changer. Now, let's talk about Victor Posner, a corporate raider with an appetite for risk. Milken and Boesky joined forces with Posner in the early 80s. Milken orchestrated a strategic move with Boesky to trigger the end of a standstill agreement. But here's where it gets dicey. In 1985, Posner raised a whopping $56 million through high-yield bonds underwritten by Milken. The catch? Posner used it to acquire Fischbach, and things went south. Self-enrichment, asset diversion, and downsizing. It was a full-blown scandal. In the aftermath, Milken faced the music, served time in prison, but here's where the story takes a turn. Instead of fading into obscurity, Milken used his second chance for redemption. Post-prison, Milken became a symbol of resilience. His philanthropy efforts soared, and he transformed from a symbol of controversy to a beacon of reinvention. In 1985, Milken was the puppet master behind KKR's takeover of Storer Communication, but there was a twist. Barred from buying stock in the company, Milken pulled off a sly move. He had Boesky sneakily buy shares, selling them later for a cool $1 million profit after the buyout price went public. This was just a fraction of the $49 million Drexel earned, highlighting Milken's relentless pursuit of maximizing profits, even if it meant tiptoeing into the realm of insider trading. Fast forward to 1989, and Milken made history with Drexel securing a jaw-dropping $5 billion to fund KKR's acquisition of RJR Nabisco, the maker of iconic brands like Oreos and Ritz crackers. The total acquisition cost? A staggering $24.8 billion. Drexel raked in over $250 million in fees for financing this colossal deal, marking it as the largest acquisition in corporate America at the time. Now, let's talk about 1986, the year Milken etched his name in the annals of financial history. Under Drexel's favorable compensation formula, Milken's department bagged a mind-blowing $700 million in compensation. Milken, being Milken, handed $150 million to his team and pocketed the remaining $550 million for himself. And that's not all. Just one of his 500 secret adventures generated a cool $400 million. His Beatrice warrants also skyrocketed, reaching an astonishing $650 million. At this point, Milken was likely rubbing shoulders with the top 10 richest folks in America. Despite his substantial earnings, Milken's determination to squeeze every penny from his deals was unparalleled. Picture this, quarreling with Drexel's CEO for hours over a measly $15,000 finder's fee. It's a testament to Milken's relentless drive and intensity in the pursuit of financial gains. But as they say, what goes up must come down. The storm clouds gathered when Ivan Boesky's world began to unravel. Dennis Levine spilled the beans to the SEC, disclosing Boesky's involvement in insider trading. Boesky, facing the heat, decided to cooperate and spilled the financial beans on his dealings with Milken. March 1989 marked Milken's downfall. A federal grand jury indicted him on a staggering 98 charges of racketeering and fraud. The once high-flying financier faced the harsh reality of legal consequences. April 24, 1990 became a pivotal moment. Milken, facing a mountain of charges, admitted guilt to 6 counts of securities and tax infringements. In a plea deal, he committed to a $200 million fine and a settlement with the SEC, pledging to repay investors affected by his actions with a hefty $400 million.